Hi, and welcome to the quarterly Real Confidence Quarterback. I'm Chuck DeRocco. I'm the head of Real Estate Research US for Altus Group. This is our first actual recorded webinar of the quarterly Real Confidence Quarterback, and we have a great guest who I'm going to introduce here shortly. Just to give you a bit of a background on the description of the quarterly quarterback, what we're really intending to do here is actually do a recap of the leaderboard itself for the 2016 University Challenge. We're going to have a great executive join us, and we're going to talk about some of the winners, some of the losers, some of the gains, and some of the falls in ranks on our leaderboard. And again, we're going to walk through this all in a webinar. On that note, I'd like to introduce our guest today. It's Christopher Lucas. He's the managing director of Capital One. I've known Chris for quite some time now, and Chris comes in with over 25 years of REIT experience, and I want to say hello and welcome, Chris.
Thanks, Chuck. Happy to be here.
Great. I figured the best thing for us to start off with was maybe a little bit of administrative before we get into the details, because I don't really want to confuse people on which challenge we're talking about. If you can watch the screen here, the easy way to find the challenges is to click on the university selection at the top. And this here, the page, it takes you right to the 2017 challenge. The 2017 challenge just started in January of this year and will run on a calendar year. That is not the one we're going to discuss today because there aren't any returns for that, but that'll be for further recorded webinars. We're actually going to go and talk about our 2016 challenge. So if you click on the All Challenges selection here, click on the 2016. Now, the 2016 was started on July 1st of 2016 and will run till June 30th of 2017. The difference is that we obviously have moved the 2017 challenge to the calendar year. So it might be a little confusing when we talk about returns. So, for example, today we're going to talk about actual second quarter University Challenge returns, but we're really focusing on the fourth quarter returns of 2016. So again, just to kind of get that straight, it will be less confusing, I promise you, moving forward once we get into the 2017 challenge. But 2016, just a little bit different structure moving forward. So let's start off and talk about the returns. Again, for the 2016 challenge, the first place we should look at returns is here, and this is our leaderboard. To the right is this university, the Real Confidence University Index, the 2016 Real Confidence University Index. The way this thing is comprised, it basically takes all of the portfolios of our competing schools, which are 32, and creates an aggregate of all of their selections and allocations. So this is the $32 billion portfolio overall. And you can see here for the second quarter of the challenge, they came in at a negative 7.78% overall. And when you look at this allocation, you can see it was heavy, obviously, to the REIT side, a little lighter on the private equity side, and really not much allocation to the debt as a whole. Let's start out on the REIT side and take a little snapshot of that. When you look at the REIT returns and its contribution to this index, it actually was down 1.48%. When you look at the subsector breakdown of it, and you can get all that from kind of scrolling down into this area here, we ended up having 5 negative sectors out of the 9 that were options on the equity side. So it really wasn't a great overall return for REITs. The quarter kind of varied. When you look at the retail REIT sector, they were down for the quarter 10.7%, as you can see here. If you jump to the other side, the lodging resorts, way up, up 20.4%. Again, big spreads across the board on the REIT sector. And I think maybe we can kind of take a look at that and open that up for a question for Chris. Which really surprises you more out of these this kind of breakdown? I mean, again, it's a big spread in returns, and why do you think we saw such a big spread in this quarter?
Well, the fourth quarter, Chuck, I think is really a tale of two periods, pre and post election, really drove the performance. So I think you think about where we were going into the election, rates had remained relatively low. They had been creeping up, but the defensive play, like a retail, clearly became less interesting to investors post-election, and they gravitated towards the sector that has the highest leverage towards the economy, the lodging resort sector. as people's expectations of an improving economy post-election grabbed hold, and that was really the sentiment for the last half of the fourth quarter.
Yeah, that makes complete sense. I know lodging is coming off of a great year. I think they reached some of their highest levels of occupancy, and it just, again, the spread's very long, but I couldn't agree more. Let's jump over to the private equity side and take a quick kind of snapshot of this as well. So private equity returns, again, only 22% of the allocation of that $32 billion aggregate pot, but came in with actually a positive return at 0.72% for this quarter. Again, when you look at the kind of the sectors and subsectors, along with some of this regional breakdown for the private equity area, again, all positive returns. It's really kind of, I guess, it's kind of expected a bit with kind of a more smooth positive return aspect that you often get from the private equity benchmark itself. But when you look at the actual trends in returns, for the five sectors have been down more or less for the last 3 or 4 quarters. One big sector that stands out is the industrial sector overall. When you get into the regional breakdown of things, you kind of see, again, this west and east, which we've heard repeatedly for years and years, continue to kind of outperform the South and Midwest. As these kind of values maybe start to mature, though, in those regions, do you think we're going to see any, capital flows to other locations, Chris?
Yeah, I mean, I think eventually the price disparity, the yield disparity between the coastal markets, which have generated tremendous flows in capital and pushed the pricing up and the yields down, ultimately is going to reverse somewhat. And I would expect some capital to start seeking out secondary markets that tend to be in the central and south part of the country, and so some of that should start to gravitate back towards a more mean disparity.
Yes, I mean, I think we would both agree that the capital continues to kind of be there, and they're looking obviously for real estate investments in the United States. I think that the play, though, agreeing with you, is that we're in a very mature cycle, and I think I'm still waiting too to see that capital flow to the non-primary markets. I mean, do you think that there will be more of that, though, in this year as we move forward?
Yeah, no, I think that's the case. I mean, I think the expectations are that while the coastal markets have certainly been the darling through most of the cycle, the reality is that given the premium pricing that they've achieved, it's hard for people, I think, to continue to find opportunities there other than certain foreign capital flows that are looking for value preservation and not really interested in returns. Those interested in returns are clearly looking outside of the coastal markets at this point, seeking better values for their investment dollars.
Right, and when you move outside the coastal, especially with the perceived understanding that there's going to be an increase in interest rates, those spreads continue to narrow, and I think you obviously have to look in some other locations.
Fair point.
The other two sectors that we're going to talk about here are public debt and private debt. As you can see, the allocation is fairly small, so I'm going to kind of keep that limited to discussion. Public debt, when you look at the sectors performance as a whole, we see CMBS giving in some negative returns to this index, where we see RMBS, again, positive returns. The RMBS sector for 2016 was up 18.1%. It continues to just be a very strong area and option for the challenge itself. And when we jump over to the private debt, not such a great quarter for them. They were down 0.05%. Again, minimal allocation. Not many universities have picked this area. So we'll just kind of leave it at that. Let's jump over to the portfolios themselves and actually look at some of the schools. As you can see here, first place, University of Chicago. Let's click on them and take a look and see how they got to be number one for this quarter. For the quarter, and again, this is the second quarter of performance, but based on fourth quarter returns, they were up 2.14%, which was really great when we just saw those handful of negative returns across the board. They moved up one position to first. They were in second at the close of the first quarter of the competition. And how did they do it? They did it a very unique way that was not seen often. They went with mortgage REITs. It went 50% to the home financing side, which added about 1.19% to their returns. Then you look at 50% of the commercial side, which added just shy of 1% overall. How do you feel about this strategy, Chris? This is different, and again, not seen in many of the university selections.
Yeah, it's really not part of my core competencies, Chuck, but I would say that certainly, again, with the turmoil that we saw in the fourth quarter in the bond market, with the strong rise in rates and the dislocation in the equity market, it's not surprising that investors went to this area as a way of sort of hiding out. It would be surprising, at least from my perspective, to see this be a longer-term trend, unless uncertainty reigns for the next couple of quarters. It's certainly a place where, as you saw in the debt returns, the raw debt returns, where the RMBS did very well, and obviously that had to do with, I think, better overall view of the collateral and of the backdrop of the economy in terms of improved outlook. But from a mortgage perspective, they tend to be highly volatile and hard to stay with them long term. They're very much a trade rather than an investment.
So I know this isn't your expertise, but how do you feel about that maybe keeping its pace for at least 2 more quarters and pulling out a win for the University of Chicago?
I think it's a challenge. I mean, I think that again, the volatility in the group has tended over the years to be high. You've got concerns about the Fed, raising rates, and to the degree that the 10-year is adjusted and you're looking at the short end of the curve going up, with the yield curve flattening, that's tended to be a negative to mortgage REITs historically. A lot of this is macro driven, but I would say it's a challenge in this environment for that strategy to continue to work its way to the top of the list.
And I think that is an interesting aspect of the university challenges, because you see these different investment strategies across the board from all 32 schools. Some, like the University of Chicago, that went for maybe a more volatile, run the risk type of approach. And maybe like you see in our second school here, the University of San Diego, which we're going to touch on briefly here, is a more diversified approach. University of San Diego was up 2 positions to second. Last quarter, they were our $2,500 top private return winner. So every quarter we give away $2,500 to the top private. That includes private equity and private debt, and top public equity and public debt winners. And again, University of San Diego took that check home last week on the private side. A great return for them this quarter at 3.06%. They missed getting that top private check again this quarter by 29 basis points. And we'll talk about the winner in a second. Again, you can see the allocation a little more diversified here: 30% on the public equity, 70% on the private equity side. When you look at the breakdown, when we jump to the REIT side, REITs, again, as we talked about those returns, they went a bit on the industrial side, which was down. Didn't really help their portfolio. Didn't really hurt it, though, when you look at it compared to some of the other portfolios. When we get over to the private equity side, this is kind of where they seem to make it work. With this being a 3.14% added to their portfolio. This really came in from this industrial allocation here. 71% of that 70% allocated to the industrial side. Again, you see that east-west play. I guess, Chris, let me ask you on this. Do you like the diversification at the quadrant level for for these last 2 quarters and this 2017 new administration, all these changes? You think that's something that might work?
Yeah, I think, what's interesting is that if you think about it, they're playing, they're betting everything on the industrial space, and how they're betting it is the interesting part, which is that the way I think about the difference between sort of the REIT play versus the private investment play is the private investment play is going to work out based on sort of the fundamentals continuing to be solid, and there's really no expectation for that to change. And so I think they can count on continued decent, consistent returns from that perspective. And clearly, the phenomenon of e-commerce is driving the boat here on this business. And so that part of the strategy is going to be a consistent, decent decent performer. The REIT side is the interesting part because that's where really, I guess you would call the alpha of their play is coming into play. And that's where that is more determined based upon sentiment on, on the handful of public REIT, industrial REITs. And there was clearly a very strong year for that group that weakened generally in the fourth quarter, I think mostly because people were profit-taking. As we head into the new year, it's still the consensus sort of best place to be from most public REIT investors in terms of what expectations are for that group. And so they seem to be pretty well aligned. Obviously, the big wild card in this, and it's something that probably doesn't play out during the time frame of this challenge, but is what does the new administration's trade policies ultimately do to the impact of trade issues, particularly in the West, as they look to maybe renegotiate NAFTA and all of that. That's probably issues that play out further down the line than the time frame for this. So I do feel pretty strongly that this is a good strategy, going into the back half of the challenge.
Well, thank you very much for that, and that I think that's going to be nice to hear for the University of San Diego. Another thing that I can add to that, Chris, is that we ask this same question, this billion-dollar question: how would you allocate it to a handful of REIT and real estate executives? We had 65 actually participate this year. That just came out. It produces the 2017 executive index as well. And as you mentioned, industrial was the top sector, not only on the REIT side, but on the private equity side. And I think it is the sector to watch. I couldn't agree more. As a lot of these other core start to mature, I think that's one sector that does stand out. So University of San Diego, sounds like you might be in the right direction. So again, congratulations for second, and sorry that you didn't get that check for the top private equity. Let's jump into the last of the top three, Chris, and let's look at Brigham Young University. They jumped up 3 positions to number 6. They jumped up 6 positions to number 3. Got that a little bit backwards as well. They, again, a top performer. They went all private equity this year, and they actually are our top private quarterly winner. They win the $2,500 for their allocation. Great performance here, as you can see, 3.35 for this quarter of the competition. Again, industrial. It seemed to be obviously the way to go. It is the top weighted sector, as I mentioned, across the board. And I think we talked a lot and gave us your opinions on industrial, so I don't want to elaborate too much on that. Maybe I'll ask you just a quick question on it, though, Chris. I know you're more retail focused as a professional, but any thoughts on the South and the industrial warehousing type environment?
Nothing specific. I mean, I think you've certainly seen improved port activity through the South with the Panama Canal shift, and so there's more demand. And I think ultimately the other big issue is housing, and there's been, I think, a rebound in new home construction in the South as it continues to gain population from other parts of the country.
Well, let's jump over to the retail side then, because this is more of your expertise. How do you feel about the allocation in a regional sense here with the South and the West, where they have their focus in retail?
Yeah, I think from our perspective, the West has clearly been an area, particularly, I guess, from a private equity perspective, where valuations have remained incredibly rich. Performance has been very good. And, from what we've seen, it's been one area where, at least the REITs that we cover have done very well. South's a little different. Obviously, population growth as migration patterns have reemerged over the last several years after sort of stalling during the financial crisis. But, the one issue with the South has traditionally been the ability for new construction to sort of impact the supply-demand fundamentals. At this point, though, generally speaking, in retail across the board, there really has been we are at a very, very low new construction level. So while that has traditionally been a concern when you're in a market like the South, the reality has been that we remain, well below, probably at a third of the level of the average new construction on retail supply over the last couple of years and likely over the next few years. So the outlook for from a supply-demand perspective looks good. And so when you think about it, you've got increasing population growth in the South with relatively stagnant supply. That's a positive for that supply-demand fundamental. And the West, again, continues because of the lack of supply and the amount of wealth that's been generated in the West, and just the population growth as well. Again, another market that's done extremely well. And the other thing about the West that's highly unique is just the inability to do new projects. That the process for new construction is incredibly painful and lengthy, and so you just don't see much, and so you're left with an inventory that's pretty static.
All right, that's great. It's all supply demand, it sounds like, and that obviously is very important for commercial real estate. So that's good to hear that retail isn't overbuilding, because it doesn't really seem to be the time. Let's look at one other portfolio, Chris. I guess scroll down a little bit for this one. The University of Miami. I kind of call this the mover of the quarter. They had the largest gain in rank. They were up 7 positions to 7th overall, and they actually are our top public sector quarterly winner. So they get $2,500 as well. They went, as we can see here, all REITs with 100% allocation to REITs. And when you look at the breakdown in their sectors, they went to a little heavier on the retail side and 35% on the lodging side as well. The lodging side, I think, was kind of their sleeping night, because it kind of obviously popped out. I don't know if that was expected in their allocation, as we mentioned before, returns just over 20% for the quarter. How do you feel about this portfolio, Chris? You think this is maybe a little luck for the quarter on that lodging call?
Well, lodging has been a very volatile investment area. I mean, if you look back, the 2015 returns were negative about 24%. So 2016 they ended up with about 24%. So they basically rebounded, and almost all of that was in the fourth quarter. And I'm pretty sure if you look at it, was mostly post-election, again, as the euphoria over this idea that we would have tax cuts and infrastructure spending, and all of this fiscal stimulus would drive GDP growth, which would impact positively lodging fundamentals and expectations. I think that's probably a one and done, particularly since I think the euphoria post-election has sort of calmed down, as we kind of now look at how difficult it is to get things done in Washington. So, I would say that this is probably a portfolio that probably needs a little bit of retooling. Same thing on the retail side. It was an ugly quarter. I think a lot of that, again, part of it was related to the fact that retail is viewed as a defensive category, generally speaking. And obviously there are deep concerns about the retail environment, particularly with department stores, given the impact of e-commerce on the business. And I think that sentiment will be, continue to be relatively negative into this year until the landscape is a little bit cleaner in terms of what expectations are. So as we kind of look at that portfolio, I think there's a couple of areas where some retooling might be needed.
Yeah, I think to just elaborate a little bit on your thoughts on the lodging side too. Again, coming off of a great year, coming off, trying to maybe riding a bit these expectations that you mentioned, but if you look at it again in that supply-demand fundamentals, I know there's a lot in the pipeline on the lodging sector, and I think that obviously can have an impact on lodging REITs, lodging private equity. Then you add in maybe that other component that's talked about frequently now is the Airbnb side. I think that we'll save that for a whole nother webinar or a podcast, because I think that can get into some deep discussion as well. Well, let's just wrap it up here. One last final question for you, Chris, overall, and I threw this out to you ahead of time so you can think about it a little bit. You had a chance to look over some of the portfolios. If you had an opportunity, and we will not hold this to you, I promise, is if you had to pick one to win the $30,000, that would be the top returns for these 4 quarters ending in June 30th. What stands out for you?
Well, again, I think it's the University of San Diego's full industrial allocation that probably seems, to me anyways, to sort of represent, I think, thematically the best opportunity for continued success. Again, my concerns on the mortgage REIT side really go back to concerns about a flattening yield curve, which has historically tended to be a negative. So I do like the full industrial allocation. Public-private mix, that's to be determined, but that industrial allocation I think makes a lot of sense.
Well, there you have it. University of San Diego. That's Chris Lucas, the managing director at Capital One's call on our 2016 University Challenge. I'd like to thank, obviously, Chris for joining us, taking the time and giving us his input here. Thank the watchers or the listeners out there for our first recorded quarterly Real Confidence quarterback. Again, Chuck Duraco with Altus Group, and please check back to the leaderboard regularly. Thank you.